Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic equity markets, which could in turn impact the positioning of our schemes. In the current quarter, Indian markets have rallied significantly, supported by FPI inflows, which have reversed over the past few months. The failure of banks such as Silicon Valley Bank was a significant moment for equity markets and central banks. The US Federal Reserve loosened liquidity even while keeping rates firm, easing yields. This led to money flowing into the emerging markets. Small caps were the clear favorites, and markets are now following a barbell strategy: small caps for domestic investors and large caps for FPIs. The Nifty index ended the month of June on a positive note with a gain of 3.53%. The Nifty Mid-Cap 150 Index and Nifty Small-Cap 250 indices outperformed large-cap indices and were up 6.1% and 6.3% respectively. Global indices Dow Jones and Nasdaq Composite outperformed the Nifty, while FTSE 100 lagged Nifty returns. FII flows continued to remain positive in June. Net FII inflows were Rs 47,148 crores. DII bought stocks worth Rs 4,458 crores, whereas MFs were net buyers worth Rs 5,664 crores. Sector-wise, all sectors ended in green except NSE Media Index. The NSE Media Index was down 0.7%, whereas realty, pharma and auto were the top gainers. The India VIX, or the Volatility Index, saw a decline in June. It was at 10.8 compared to 11.97 in the previous month, lower by 9.8%. A lower VIX could signify potentially low volatility and a stable range for equity prices. Further, India VIX has a negative correlation with Nifty 50. Nifty PE has seen a correction, and the 12-month blended forward PE has come down by around from the peak. Nifty price-to-book ratio has also come down from its December 21 peak of 3.7 to stand at 3.3 as on end June 2023. Globally, equity markets and debt markets seem to think that central banks may not raise rates very much more, even as central banks ratchet up their firmness to tackle inflation. Why would that be? For one, inflation seems to be on a downward trend from a commodity perspective. Nearly all manufacturing inputs have declined considerably over the past year. This has led India's WPI to turn negative 3.48%. Second, we believe that a prolonged high interest rate regime will prove onerous for both individuals and governments to bear, leading to rising fiscal deficits and problems in meeting higher mortgage payments by individuals. Third, emerging markets ex-China have come through post-COVID with better balance sheets and lower current account deficits. They seem poised for the next leg of growth and seem to be better placed than many DMs. India has been able to manage its current account deficit and fiscal deficit, setting the foundation for sustainable growth. Indian markets are at all-time highs with strong FPI flows and domestic SIP or systematic investment plan flows coming through. Valuations on a trailing basis are in line with 5-year average for large caps at 24x, while mid caps are trading lower at 27x versus the 5-year average of 35. However, current valuations factor in significantly lower leverage and cost of capital and are closer to peak operating margins. Indian markets have enjoyed robust inflows, and as a result, markets have gone for a good run. 12 months of continuous inflows has pushed 81% of BSE 100 stocks to trade above 200-day moving averages, an indication that markets are overheated. India's economic health has continuously improved, with fiscal deficit and current account deficit under check. Manufacturing revival is promising, while services growth continues. Banks and corporate balance sheets are in the best of health. This will enable companies to grow sustainably for the medium term. Markets can continue to trade at high levels for longer than we think, yet one needs to be cautious given the uncertainties that we face. We advise investors to continue to invest in a measured manner into diversified funds such as flexicap, value or mid-cap funds. Some concerns. Monsoons have picked up in recent past, but the overall sowing has been lower than last year. Lower crop output could lead to lower farm incomes, impacting rural demand. Continued impact of inflation has impacted household consumption, and this could continue. India has navigated the energy crisis well, but a sudden spike in oil and crude prices may lead to inflationary pressures. We're also witnessing some competitive currency devaluation, which could impact India's export competitiveness. Lastly, elections could turn aggressive and change the fiscal discipline followed until now. Waivers and freebies have been used by opposition parties successfully, and were this to continue, it may lead to competitive SOPs, leading to significant fiscal deterioration.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.